for many years, and he's back with us this morning. Marc, thanks for coming back. Everyone characterizes you as a bear, but when it comes to U.S. equities, you're maybe not as bearish as some might expect. Is that fair to say? I'm
actually an optimist because I ride motorcycles in Thailand, and for that you have to be very optimistic in life.
Right.
But I think, it's not a question of being bearish all the time or bullish all the time. Sometimes there are asset classes like commodities in 1999 to 2001 that were very depressed, and then you can be optimistic. Or Asia was very depressed after the Asian crisis, or Latin America in the late 1980s, or Russia in 92 to 93. So it's a question of trying to find something that is inexpensive. I think if someone must own equities, then U.S. equities are not terribly expensive compared to emerging market equities. Emerging markets are more in the bubble stage than the U.S. because the dollar has gone down.
And your chart that sort of makes this vivid is Walmart versus the Shanghai index.
Yes, exactly. Yes,
what does it tell us?
Well, basically,
if you can't figure it out from looking at it right there, right? I mean, that's pretty obvious.
If you consider that in China, the market is up 6 times since 2005, admittedly from a low level, and that out of the 20 largest market cap companies in the world now, I think about 8 are Chinese, then of course over time Chinese companies will become very big. It's like, I suppose 100 years ago, American companies became bigger and larger in terms of market cap than European companies. So you have these changes once in a while in the world's economic geography. But if your largest customer, the US, isn't doing well, and within your largest customer, the US, essentially the largest company, Walmart, isn't doing well, and you keep on rising, then you think that something will change one day. And today, I think I would rather buy Walmart than the Shanghai Stock Exchange Index.
You were on our evening program at the time,
yes.
On the Money, January 29th of this year. Here's a quick bite of what you said at the time.
I think that we could easily correct between 7 and 15%, and especially also in emerging economies.
All right, but you said correct between 7 and 15%. I believe you were probably referring to the Dow, perhaps, or the S&P?
I was referring to markets, to the forthcoming February-March correction.
And obviously the Dow up 8% for the year to date. Did people lose money if they followed your advice at the time?
No, they didn't, because they essentially got out. And I have to stress one point. If you have a weak currency, in local currency, the market can go up, but internationally, in a strong currency, you don't make any money. Say gold is up 21% this year. The S&P in euros, expressed in euros, hasn't made any money yet.
Right.
It's made 9% in US dollars, but not in euros. And so overall, I think that the advice to avoid housing stocks since 2001, especially the subprime lenders since last year, and financial stocks, has been actually quite good.
In your view, the credit crunch, the mortgage crisis, is it going to culminate in moving vans, people leaving their homes in droves on the evening news, or will it be more like Chinese water torture, where we get days like Friday from time to time?
I think it will be the Chinese water torture. But I think that the problem in the credit markets is that if you have a problem somewhere, it can infect other markets and spread to other markets. It started in the housing industry. I think it can spread to credit cards. And so the banking sector and also financial stocks, that's where the big bubble is. Because if you look at earnings of the S&P, 1990 to today, financial sector earnings up 5 times. Non-financial sector earnings doubled only. You and I, we are the bubble. The hedge fund industry, the financial service industry, we are the bubble. And that needs to be deflated very badly. I'm sorry to say.
Okay. Even financial news on TV, we're part of the bubble. You just called me part of the bubble.
Yes, you are part of the bubble. I'm part of the bubble because I also benefited from it.
Yes.
Because my customers are basically people, financial people.
Yeah. Marc, thank you. We're going to see you again in the 8 o'clock hour. Marc Faber will be with us in the next hour with his best long and best short positions.
Yeah, again, that's coming up in the next hour. Also ahead this morning.